My name is Wolfgang Münchau. I write for the Financial Times, and we have a panel this morning with the title Banking in the Age of Financial Repression and Public Hostility. It's not exactly a lighter subject than the one we had before, but we hope to have a very interesting discussion on probably on an issue which I believe is going to be quite important, because we're seeing a very fundamental change in the nature of banking and certainly in the perception of banking, and we wanted to get to this in this panel in the next hour. I'm very honored to have a very distinguished panel, which I would like to introduce. From my left, we have Urs Rohner, the chairman of the board of directors at Credit Suisse. To my immediate left, we have Sergio Ermotti, the group chief executive of USB.
Yeah. USB stick would be better. UBS. Sorry.
I should have really brought this to right. I should have written this down for.
What is
so it is UBS. Just wonder what USB is, other than a technical device. But we have Douglas Flint, the chairman, the group chairman of HSBC. I hope I got those letters right now. And Martin Senn, the Chief Executive Officer of Zurich Insurance. So I got the names right and the companies right, -1, so that's a reasonable achievement. I also have a list of 7 subjects with which I will introduce. I hope I can remember all of the 7 subjects. I have written them down, but I'm trying to do this without the list. The challenges of banking, I have a list of about 7 issues that banking faces. These are disparate issues. They're not complete and not entirely structured, but these are the 7 things that came to my mind when I prepared for this panel. The first is financial repression. Financial repression is essentially when your friendly finance minister comes to you and makes you an offer that you can't refuse in terms of the purchases of local or national government bonds. Maybe he sends someone else along to make you that offer, which is worse than if he comes along himself. A second challenge faced by banking is deglobalization. Now you remember the famous paper written by Kenneth Rogoff and Carmen Reinhardt, which has been discussed in the media in the recent weeks. Now the one issue on which the 2 authors do not agree on is financial deglobalization. Carmen Reinhardt believes this is one of the main features we're going to see in banking in the next 10 years. Deglobalization will not be decided centrally, but it will come subtly through regulation disguised under financial, money laundering legislation in other forms. It's already hard to open up bank accounts in countries where you're not resident necessarily. So the idea of simply shifting your money, if you're not a sophisticated investor, if you're a retail investor, if you're a Cypriot investor, it would actually not have been that easy to set up bank accounts in Northern European countries and shift your money out in time before the capital controls stuck. Now, the second group of issues facing banking, which I call sort of the political, legal, and social. The political is that we are starting, and you'll see this in Germany, where a large opposition party, or the largest opposition party, in fact, is running a campaign based on exploiting the distrust of banking and finance. I've not seen this before. I mean, we've seen discussions on banks and banking and finance, but essentially the main campaign idea is an anti-banking ticket. And we've not seen this before. And they may lose the election, they probably will lose the election, but it's still interesting that a large party believes this is a way they can win an election. And their own research is showing that this has a widespread support. So they're railing against bonuses, against, they want more regulation. A lot of it is pretty imprecise. But it's generally feeding on a sentiment. The legal depends on there are legal cases and tax evasion cases, famous tax evasion cases in all European countries now. Some banks are being dragged in front of in front of the courts, allegedly helping tax evasion cases. So there will be legal challenges in criminal law, not just in civil law, facing banks in the next year. And this is the social thing. And this is, since we are in St. Gallen, a university, it was a cool thing for young graduates to join banks and financial companies in the last 10 years. The question is, will that be the case in the next 10 years? Will that still be the place where young graduates want to be, looking at those changes? I can detect a certain shift in sentiment among young people about relative coolness among various employers. And the banks being very much at the top, are probably not at the top anymore. I must say, journalism was used to be once close to the top. That isn't the case anymore either. So I know what it feels. I know what it feels. The sense of vertigo. We know that well. And the last 2 points are technical. One is, I do remember my 7 points. One is the future of potentially negative interest rates. We've seen yesterday the president of the European Central Bank, saying that possibly the deposit rate becomes negative. This is going to be a different environment for banks when interest rates become negative for a longer period of time. Business models change, certain products can are different. And another factor specifically in Europe, and that is also a challenge for insurance companies, not just for banks. We have been very bank focused in my questions, but some of these issues affect non-banks, financial institutions, and insurance companies in particular as well. And my last point is the trend towards securitization. And this is a trend that we are likely to see in Europe, where we've had traditional bank relationships. Again, the ECB is now investigating possibilities to step up securitization markets for corporate lending. So there might be structural shifts in the markets, which is not necessarily a challenge for banks in the sense that it's bad for banks, but it will change business models. So enough of my analysis. I would like to ask the panel to either respond or contradict or make their own points, add or subtract points. Could I start with you, Mr. Rohner?
Well, thank you very much, Mr. Münchau. You laid out an impressive list of topics. So for me, it's a bit like in a Chinese restaurant. I can pick the one I like most, since I'm the first one to speak. So I don't pick the coolness point. I think it will still be cool for young people to join banks and financial institutions going forward. I think there's a lot of potential there. But let me pick the one that you had as number 2, deglobalization risk. Because with that, you can explain a little bit what has been going on in our industry in the last couple of years and what the likely effect or undesired side effect of it may be. I also view that as a big danger for global finance or for finance at large, the deglobalization risk. And it's not probably what originally was intended, be it by the FSB or by the G20 or others, but it's a side effect of the way we have, or politicians, governments have tried to repair what they would call the overall financial system. It started with regulation. We had a couple of, I would say, global initiatives. So take Basel III as an example, new capital rules, new liquidity rules. Take the big topic of too big to fail, an important topic. Principle being no banks should be big enough that it cannot basically exit the system without creating havoc to the system if it fails. That has led to national legislation. In Switzerland, as you probably know, we have had a very, I would say, in-depth analysis of the problem. We have come up with new regulation very quickly. We have also implemented that regulation, contrary to many other countries. And I think we have a fairly clear set of very tough capital rules, also liquidity rules that are based on Basel III. Now here comes the trouble. Other countries have then started to do their own thing as well, not just purely based on what I would say globally aligned principles, but some governments have decided, or some states have decided, well, maybe we defer Basel III a little bit, or we do certain other things. Then other countries have come up and said, well, that's not good enough for us, because I think we need some extra protection for our own territory. So in England, you see obviously a clear trend towards ring fencing. activities that may result in for globally active banks to have to come up with even more capital in order to satisfy those local rules. In the US, it normally starts with a speech given at Yale, and then it translates into some regulatory concept. We now have the concept of intermediate holding companies for foreign banks that may, depending on how your bank is organized, may create an additional burden in terms of capital. All of those activities taken together will result in higher capital rules for globally active banks, and it will, in the end, or at least there is a danger that this would happen, it will result in I would say, a less globalized financial system. That's the end effect, and that's something that I view as a real risk, because it goes counter to the activities that governments are otherwise proposing, namely to try to stimulate growth. In my opinion, there is a big danger that the result of all of this regulation, they have not even talked about the technicalities of the regulation, which add an additional layer of complexity, be it on the operational side, on the IT side, which results in additional costs, but also in additional risk, which will force banks to pull out of certain markets that are just not profitable enough anymore. All of that has the same effect. It will reduce, I would say, global finance in the way we have seen it before. So, I mean, as an overall topic, I would say that this is probably one of the biggest dangers I see. And if I can encapsulate it in one topic, it is the inability of, I would say, of the global community so far to come up with a credible system as to how they deal with the too big to fail issue. That's the final cornerstone in the whole regulatory discussion that has not been adequately addressed. We have warned about it already 4 or 5 years ago. I said we'll have to have globally aligned rules. They have to be based on a number of principles. Cannot have 100,000 pages of legislation necessarily, but a couple of principles, including mutual acceptance or recognition of acts that are taken or decisions that are taken in one country, and make sure that you can wind down a globally active bank or financial institution across boundaries in a decent way. If you resolve that problem, then I'm sure a number of all the other problems that we are seeing now that are being built up would go away.
Right. Okay.
Thank you. First of all, if I look at the title of this topic here today, I would echo many of the comments Urs Rohner just mentioned about, some aspect of globalization. I have a hard time to understand how you can deglobalize the financial system and still having a global economy going on. I think I would like to understand who is going to finance and fund a global economy if you have just nationalized banks. Having said that, I think that when we go through the topic here, I like to go through a little bit of an analysis of what happened in the early years with one clear statement at the beginning. I think that banks contributed in a meaningful way to the financial crisis, the creation of the financial crisis. But for sure, I would say that central bankers, regulators, investors, being shareholders or bondholders, all of them, even consumers, enjoyed an unsustainable long time of low interest rates environment. The illusion that in the last 15, 20 years you could flatten out basically the structural economic cycles that we have been seeing for many, many years. So that created a bubble. Bankers were responsible for not doing anything, actually trying to take too much advantage of that situation. That created the financial crisis. Now, we all take the responsibility. Now, moving forward, what happened right now, I'm going to the public hostility. The public hostility is a consequence of the ongoing denial by all stakeholders to recognize that this is no longer a financial crisis. I think that banks can still improve their capital position, by the way, was necessary to improve the capital position of the banks and the liquidity and funding position of the banks, but this is just not enough. Just to quote you a number, the amount of bonds outstanding bonds issued by governments at the end of 2012 was $47 trillion, which is 50%, i.e. $15 trillion more bonds outstanding issued by governments between 2007 and 2012. So this is a clear indication that there's something wrong going on in our society other than the banking system. We can find out the best way to put through a resolution regime banks and could capitalize them, but the fundamental issue is that the public has to understand that the society and the system we are living in is not sustainable any longer. It's too nice and too short-term. You have been mentioning the banking bashing in Germany coming up again as a political in the political debate. Is way. I think that it's not as a banker. I'm not talking as a banker here. I'm talking as a public person. I'm talking about the next generation. It's totally irresponsible to continue to discuss about the describing this situation as a financial crisis is the problem, and we need to address that. Clearly, there has to be. We have to see reforms in the social. In the social welfare space. We have to liberalize our economies. We have to recognize that many aspects of the wealth creation that we have been seeing the last 50 years in the Western countries, particularly in Europe, are not sustainable any longer. And that's in my point of view, that then can be added to what should be the role of the banks going forward. Of course, banks need to focus on, in my point of view, on three main aspects. First of all, is having a business model that can create sustainable financial performance to its shareholders. And in order to do that, you need the second element. That business has to be client-centric. You have to do what clients want. You have to avoid using the means and the balance sheet and everything that is at your disposals for things that are not related to clients' activity. And the third issue is to basically make sure that your third most important stakeholders, your employees, feel proud, as I feel proud, even today, to be a banker. You can't have this bashing going on forever. And actually, you were describing the privilege of having achieved to a better ranking as a journalist than a banker. I think that is a close race to the bottom here between us, you, and the politicians. So we can be very happy about all that, but it's a self-fulfilling issue that goes on and needs to be addressed. So, in my point of view, we can come up with all the issues that we want about how to resolve the banking system. I would just maybe take on what Urs just mentioned. For sure, we need clear global coordination. If you look at the UK, the US, Basel III, Switzerland, Germany, every country has its own way to interpret the rules. And that's not sustainable, clearly. You cannot run a system like that.
Okay. Pandik, another. Economists are another profession that join us in that race at the bottom. Douglas Flint.
Thank you very much, and thanks for the invitation. We bankers don't get invited out very often these days. I think one of the things we have to recognize is society's expectations are changing, and they're changing because what has fundamentally been destroyed in the last 5 years is society's belief that the outcomes that they believed were predictable from the steps they were taking to secure their future turned out not to be predictable. And as we look back, it's kind of, we all can recognize the sort of the missteps that were taken in a broad sense. I mean, people believed they didn't need to save for the future because their houses would take care of all the savings they ever needed, so they could consume. They believed they could get onto the housing market without ever putting any money down. They believed that the growth would be such that even the demographic bubbles that were evident in the world would be able to be catered to in terms of healthcare and pensions and so on and so forth. And when these expectations are are challenged and indeed destroyed, one looks to sort of say, well, how on earth did that happen? And I think the banking industry has quite a role to play. Everybody now is focused on how do you get sustainable growth back? And I think that the title of this session is really important, because you don't get sustainable growth through repression and hostility. You get growth if people are more confident about the future. And if you see sort of one theme coming through so much of the dialogue, it's now is how do you rebuild confidence? Confidence requires trust. Trust that the transmission system works and is being directed in the right way. Trust in the motives of those who operate the transmission mechanism, the financial intermediaries, banks, shadow banks, insurance companies, whatever you want. And trust that the information asymmetry that's been highlighted in some of the missteps have been eradicated. One of the things I find fascinating in the dialogue I have with public policymakers is there's a simple question that hasn't actually been answered. If we think of the extraordinary amount of things that have been done in the last 5 or 6 years in response to the crisis, they've been around reshaping of the industry and telling it what it must never do again. If you actually said to anybody, whether it's in the States or Europe or anywhere else in the world, just on a single sheet of paper, describe what success looks like. In 5 years' time, assume you've got anything and everything you wanted. What does the financial system look like? You know, where's the origination done? How's the pricing discovered? Who underwrites it? Who distributes it? And who's the end user of every asset class? And I think if you answered those questions, you would then begin to shape a regulatory system and a public policy system that would respond to kind of the end game you're getting to. But at the moment, it would be extraordinary if the aggregate of all the individual micro measures that are being taken end up with a coherent system that meets society's objectives. I mean, the simple and obvious example to use today is when people talk about sustainable growth, they talk about the single asset class that could do most to sponsor that growth is infrastructure spending, and yet banks no longer are capable of holding long-term assets, and certainly in Europe under Solvency II, neither are insurance companies, increasingly pension funds. So you sort of stand back and go, well, if this is the solution, then how come we haven't got something that incents it? A couple of other points. I think one of the things we're struggling with in terms of the framework is, are we trying to regulate actions or outcomes? And I think we're moving ever more into trying to regulate outcomes, which is much more difficult. And I guess it pauses you at a sort of an obvious statement that one of the reasons I believe that we've spent the last 5 years focusing on capital, liquidity, structure, central counterparties, compensation, and all these things, is you can measure them. Someone can actually say, it used to be this, and now it's this, double the amount of capital, triple the amount of liquidity, whatever you want to do, splitting up the banks. And yet more and more people are observing that it's actually about culture, ethics, behavior. But these are very difficult to measure. They're very difficult for a regulator to say, I can monitor behavior and culture and how things are done. And indeed, the regulatory framework doesn't ask them to look at these things. It asks them to look at concentrations of risk and all that kind of micro stuff, but doesn't kind of say, how do these people recruit people? How do they assess them for their behavioral characteristics when people are recruited to the organization? Is it just they're great revenue producers, or do they actually go through an assessment for their individual characteristics? How's that reviewed as they go forward? How are people's behaviors within the organization assessed, and are there challenges to people who are great producers but actually exhibit their own characteristics, and so on? And I think that's an element that a lot of people are going to have to think more about. I mean, these are simplistic statistics, but they amuse me just to make the point. If you look at the Independent Commission, and I wrote these down because I can't remember them. If you look at the Independent Commission of Banking's report in the UK, the word capital was measured 463 times. The word culture was mentioned 6. In the FSA's report on the failure of Royal Bank of Scotland, capital was mentioned 1,389 times. Culture 122. But when we get on to the more recent report on the failure of HBOS, capital 31, culture 27. So that the balance is changing away from that which you can measure to much more judgmental factors around behavior. A couple of other points to get my little obsessions out of the way. Too big to fail. Such a simple concept. I mean, it's like beauty and everything. One of the things that I think is fundamental to the debate is to recognize there is no money other than our money, i.e. society's money. There seems to be a myth that if you could suddenly just put enough capital and liquidity and bail-in capacity into the banks, they could fail and somehow no one would be hurt. If the shareholders are wiped out, that's fine. They take that risk, albeit that's part of people's savings. If you bail in the bondholders, I mean, that's just the pooled savings vehicles of insurance companies and pension funds. So there is no money apart from our money. It seems to me, to take an analogy from the previous session, which I thought was fascinating, at the moment we seem to be debating among nations what the body count should be in respective nations of another world war, and agreeing where we bury the bodies rather than working out how to avoid the war. And that's what we should be doing. So I think I'll stop at that point, but make one more, and it's to the financial repression point, and it's not just the forcing of government bonds onto people. If you actually analyze the financial systems of the West in particular, but actually broadly, you come back to the fact that the current architecture we have for time immemorial and ever increasing, in sense, allocation of assets into two asset classes, government bonds and residential property. And those two, and in fact, if one was really trying to reshape the system, one might start with an analysis that says, if we're trying to create economic activity, are these the two asset classes that we want the financial system to be most incented to support? Thank you. Yeah.
Thank you, Wolfgang, and good morning, ladies and gentlemen. When I think about public hostility and the interventions from my colleagues on the panel, I start thinking about the fact that we're not only in an economic crisis, but maybe more importantly as well in a crisis of confidence in many parts of the world, particularly here in Europe. And with that crisis of confidence, not only with regard to the private sector where leadership is being questioned, particularly in financial institutions and banks, but also in the public sector where political leadership is seriously questioned. And with that, inherently, there is a demand for more regulation from the public. And I think there's no other sector where this demand is being expressed so strongly, like in the financial sector, which is leading to substantial intervention in its activity and in the opportunity to really meet the demands. And as well with this crisis of confidence, there seems to be, I think, a vacuum in recognizing what the importance of this sector, of banks, insurance companies, to any society. It is the banks which give credits to enable innovation. And it's insurance companies which make the unpredictable predictable. In other words, we help people to get back on their feet when a disaster strikes or a factory burns down or whatever there is. So people have a chance to start again. And if the intervention on the back of this lack of confidence through more regulation leads to a situation where the oil is not, or the machine is not as oiled as it is, it becomes pretty complicated and challenging to keep an economy, particularly if the economy is at their feet, to bring them back up. And you see that typically, say, if you compare the United States, where things seems to start moving ahead somewhat, and where the debate in terms of the criticism, call it, on the financial sector is sort of lowering, versus Europe, where we're still in a pretty hefty debate on how to intervene and how to sort of make sure that the mistakes in the past do not appear again. I think there's no discussion. Whenever by the way, I still get invited to many panels. And I know you do as well. But when I have this discussion, I realize that the financial sectors has realized what the mistakes have been in the past. And there's a huge amount of effort that's being undertaken now, not only because of the change of regulation, because it's just the right thing to do in order to get things sorted out. And my wish is really a realization that the financial sector and the public sector move together into a crisis. And only together, the financial sector and the public sector, or the private sector and the public sector, only together we can get out of it. And I hope that the debate and the discussion will become, moving forward, more balanced, because eventually the key issue is to get the economy growing again, and with that as well enable the financial sector to support that growth, as this is the only basis to create as well jobs, which I think is absolutely the priority moving forward, and less so kind of trying to get the hostility settled as such. And with that, I hand back to you, Wolfgang.
Okay, well, thank you very much. I think you all have, in some ways or other, made the point that we are society and banks, we're all in this together, and much of the public debate does not accurately reflect that. Certainly, I mean, I follow the debate in Germany. It's slightly different in the UK, but in Germany in particular, the debate is, it seems to be the banks and us as completely different, as two different worlds that have no relation to each other. Could I ask you for a technical point that I've sort of mentioned in my short summary in the beginning, the impact of negative interest rates, assuming that our economies now, we're looking at another weakening in the conjunctural cycle, at least in the very short term, there is the possibility that in Europe we might move to negative interest rates. This hasn't happened yet. Denmark has experimented it with some problems, but negative interest rates are a feature that are not known. Central banks are very reluctant to endorse them because things might happen that we just have no experience of. And in Denmark, certain things happen, certain things, unexpected things happened in the banking sector about incentives that were misaligned, etc. If we got to a situation where we have negative interest rates for longer periods, what would that do to your banking models and to an insurance company? I mean, you have probably, presumably, your insurance companies will presumably, have to guarantee returns to investors. I mean, it's a different world, isn't it? Anyone?
Yep. Well, let me maybe pick up that ball. I think it's not only about negative interest rates, and we're already in that situation where we have very low interest rates, which is definitely an incredible stress. There, probably if I talk for my company, naturally that has a huge impact because the majority of our income is generated through our investments, and if interest rates are low, you have less investments. I think that's something you can deal with somehow if you stop giving guarantees which are dependent on the income in financial markets. But more severely, so companies eventually will make less money moving forward. But more importantly is the change in demographics. We all, thankfully, we become much older. But for that age in pension programs 30, 40, 50 years ahead, we have to make sure that these pensions are funded and that these pensions sort of are funded in a way where we can save money. And if rates are at zero or below zero, there's no basis for savings anymore, which is an incredible challenge already now at low interest rates. And we know virtually with the change in demographics and the current level of interest rates, most pension plans, be it private or be it public, are in huge deficit. And a lot of the assumptions and the models in these plans are, as it stands now, modeled with potentially a lot of hope factors, i.e. modeled with higher interest rates than we currently have in the real market. And that is a tremendous challenge. And the challenge means that in the developed world, it will lead to less prosperity. And that's probably as well politically a huge challenge to accept. And that's why it's such a hot potato no one wants to touch, because it needs significant reform in the pension plans, which will translate immediately to an expectation of less prosperity, particularly in this part of the world.
Okay. Yeah. Just 2 quick points. We've got negative real rates in most countries today.
Real rates, that's up, but I'm specifically talking about nominal rates because there's something there is a difference in terms of the way savings.
It is, but there's still a huge transfer today between savers and borrowers, and of which the biggest is governments. I think if you had negative nominal rates, I mean, the thing that would scare me, apart from the impacts on the savings sector, which would become the fault line in the financial system, I think, would be how would you protect yourself from asset bubbles? I mean, even today, people are preferring putting their money again into real estate because of very low interest rates. If rates were negative and people had a perception that property wouldn't fall in value, you're effectively getting a real return. So I mean, allegedly. So I think you would have a massive asset bubble problems, and you would also have massive flows from the developed world into the emerging world, which would give them huge capital problems in terms of capital inflow, outflow, and competitiveness. So it would be politically very, very difficult.
Well, from my side, I think that maybe I take another angle. One of the common beliefs, or I guess many people think that low interest rates are good business for banks. Actually, I guess many of you here knows that is exactly the contrary. Actually, banks have a better business environment when rates are higher. And one of the real issues with public, going back to public, and you also saw the recent statements made that, well, now that rates are low, banks should really lend. Now, the problem is not, we have to add on two very important issues here. The procyclicality of the new regulations are so massive that no central bank policy will be able to offset the deleveraging that goes on in the system and the global financial market. So that's one point. The second point is the country risk premium, or the credit quality of the borrower that is not taken in consideration. If you look at the credit spreads of sovereign bonds across the globe, and particularly in Europe, you have a very elementary outcome in which is quite clear that it's not just a credit crunch created by lack of supply of credit, but you can create a credit crunch also by putting an interest rates level in spreads that is so high that is not sustainable. And banks cannot lend, by definition, only to the least good clients. And if you have a financial system that is not able to basically protect the other stakeholders, because banks are in the middle of they are lending, but they are also borrowing. They have to protect the depositors. People forget that we have a duty, I mean, and more broader commercial banks, not only to lend money, but we have also, all of you, all of us, depositing money. And they trust the banking system to do a good job in the intermediation between deposits and credit. So it's very important, in my point of view, to understand how this low interest rates environment, how can we avoid bubbles and all these issues, but also how do we educate ourselves and society about that low interest rates doesn't mean free money for everybody, if you don't address the issues that I talked about before.
I think on top of everything that was said, is actually correct. I mean, the huge transfer of wealth that we're seeing right now from savers to the public sector, just being one element. I think in addition to what was said, I think one element in terms of the impact on the banks, of course, deposit excesses will go down, and as we all know, particularly in the universal banking system, that's a substantial part of the funding base of banks, and of the solid bond funding base that we were having, actually much better than wholesale funding, as we have seen in the most recent crisis. So from that perspective, I think negative interest rates, and nobody can actually predict what the impact would be, but the danger or the likelihood is that those were to go down, and that would then, even on top of everything else, apart from obviously lower interest net interest income and so forth, would also potentially have a negative impact on the funding of quite a number of banks.
Yes. There would be all sorts of other technical, like money market funds, business models,
yes.
being challenged. I mean, there would be quite a lot of collateral damage, and as the point about non-bank type savings instruments, that people would probably circumvent the whole financial system and invest in all sorts of commodities and
hoarding and property bubbles, and it could be quite a. So it is unknown. We are in unknown territory, and you know, while I understand the real interest rate argument, there is something, you know, because there is a psychological element in people's behavior, and once nominal is negative, we could probably see a break. People are not entirely rational. The questions from the audience. We have about 10 minutes left for questions to the panel. Otherwise, we continue our conversation here. Do you see anybody? Oh, there's a gentleman at the back. And
I wanted to address the issue of public hostility. And just to start off on this, I want to acknowledge that, yes, of course, banks and insurance companies provide incredible value to our society. But I think that the fact that there's a need from the industry, and I've read this before, and as we heard from Zurich, Martin, your defense of the industry as explaining this to society, or as something that you feel that has to be explained, is an indication of what I think is maybe a misunderstanding, at minimum, of the reasons for public hostility, and at more of an extreme, perhaps, arrogance on your part. So from UBS, we received the explanation for public hostility, or as why the public should no longer be hostile, is that we're no longer in a financial crisis. And from HSBC, we received an explanation that society didn't really understand risk, that things that turned out to be unpredictable. And what I would like to posit instead is that the reason why the public is hostile, or you perceive the public as hostile to the banking system, is that the game appears to be rigged in your favor in such a way that when behaving and acting unethically and immorally, that there does not seem to be a sense of justice applied to the banking system. And what I mean by this is, for example, with UBS, with the LIBOR scandal, or with tax evasion, both of which you've been prosecuted for, and HSBC for being prosecuted and fined for money laundering. Unfortunately, Elliot Spitzer called you something to the effect of, the extent to which money laundering was rampant in this institution is just unfathomable. I think that based on the plenary session yesterday and the plenary session today, that we obscure the issue of personal morality and leadership and responsibility with this issue of regulation on corporate risk and corporate responsibility. As leaders of today, I think that we, as the leaders of tomorrow, expect to see greater leadership in morals and in ethics. And what I'd like to know is whether you, as leaders of today, feel that yourselves are acting ethically and acting morally. Thank you.
Yes, it's kind of question where
you go
say,
first.
Yes, please. They will say, I'm glad you asked the question. So
I've been asked to go first. So
thank
you for this intervention. And I should say I truly understand where the public comes from. Because there is no way on how to try to explain why things have gone wrong, why it's not admitting that terrible mistakes have been made. And I couldn't agree more with you that it is of paramount importance to get to a basis where the culture, where the beliefs, and as well where a conviction to lead a multi-stakeholder approach, where you make sure that all stakeholders benefit in one or the other way equally. The customers, the employees, and the shareholders, they are people. And these people together form the communities and societies where we live and work. And with that, we as well have the community and the society as a stakeholder we have to take serious. I firmly believe that moving forward, This will become more and more the pace. And with that, I also firmly believe that the industry in itself will become much more critical to peers within the industry which deviate and do damage not only to the financial sector, but the community at large. And that's probably what is needed, to become much more critical with each other, as you rightfully as well express a lot of criticism. Frankly, I do not think it is regulation that can enable that. It's got to come from the heart. That will take time, but I'm personally convinced this is happening, and I see a lot of good examples where this is happening. Unfortunately, where we have negative deviation, it is a bit of populism, frankly, which puts up the outliers and puts them above everything again. When I hear that bankers are bad, I've been a former banker too. I think of the millions of people working in a bank around the world, behind the counter, behind the branch, on the call center, which do a magnificent job. And it has been the few in some institutions which just did not do as good of a job. That's been recognized, that's been solved, and at one point we got to come to an agreement that let's move forward from here and give ourselves a chance in order to settle the past.
Maybe if I can add, since these things, I have to say that again echoing some of the comments Martin just made, I have to be crystal clear that banks, and particularly you made a reference to UBS, made mistakes. Time will tell how broad these issues have been, and we played guilty. We said we made mistakes. We paid a fine. We keep to be sorry with society. But if every time we speak, people come back and tell us that we are arrogant because we are just trying to contribute to the debate, that's becoming unacceptable. I have to say that we have to have the right to contribute to this debate. After we say we are sorry, I think the vast majority of the people that works in the banking system are honest people, and people made mistakes, and we are trying to address those issues. I have to say that, and I see the point. We are not in total denial, but we cannot continue just to take this populistic and simplistic view of the world. And by the way, allow me to tell you that you should probably use different example of when quoting people about morality and ethics than the person you mentioned. Because absolutely, that's the problem. We cannot let this kind of headlines being the one used to make example on how banks should have behaved. There are other sectors of our industry and our society that went through, I can't talk about the tobacco, the pharma. Every sector is part of the society. We need to focus on the problems we made and the errors we made, fix them, and going forward in a constructive way. We are not perfect. We are human. But we cannot do more than admitting mistakes and looking forward.
Let me maybe add one additional element to it. And I think the big difference of the financial sector from, I would say, other industries that also have had their fair share of problems, or politicians, or central bankers, or whatever, is that because the issue was so big, and the problems were so big, and the things that happened were so, I would say, unacceptable in terms of degree, that, we, in a way, I would say the sector, at least momentarily, has lost the benefit of the doubt. In other words, what does that mean? We have to do more to make absolutely clear that we do not tolerate certain behavior, and we have to do that not just by paying lip service or by drafting code of conduct, but by actually taking action, decisive action, if something happens. And that's probably an area where I must say, judging from my own experience, the sector in the last 15 years or before the crisis, probably that was not its strongest point. In other words, too often when something happened and somebody violated maybe internal rules, it was a slap on the hand, but it did not have severe consequences. I can tell you that has changed in my company, and I'm sure it's the same in most other financial institutions. People are absolutely clear if somebody intentionally violates our code of conduct, our rules, and we find it out, no matter who it is, it has personal consequences that can be extremely severe. And we do that. And that, I think, is a paradigm shift. It's something which we have to continue, and it's something which will take time. And every instance where you have somebody out in a company of 200,000 people who does something which is really bad, and it comes to light, will basically put you one step back in your attempts to create it. Over time, the only thing as to how you can do it credibly is if you continue on that path and you demonstrate times and over that you will not tolerate a certain behavior. I think that's the only way as to how we can also fix it from a reputational point of view, which a point that I clearly see in your intervention was an obvious demonstration of that, of the perception also of where a lot of people see the industry at the moment.
Can I make a different? I mean, I agree with what you said, and actually, I would also say I don't think it actually matters what bankers think about our reputation. It only matters what's reflected back to us by society. And I think, you know, we had some humbling, horrible experiences in the last 2 years, and I think one of the worst things anyone can ever be involved in is discovering they didn't know everything that they should have done, and that things were happening that were not supposed to happen. So one has to repair that in a whole bunch of ways. The broader point I want to make, though, is one of the things that worries me is that over the last 20 years, one of the successes, I believe, of the financial industry in its broadest sense has been a huge progress in financial inclusion and huge progress in connecting some of the world's poorest markets through economics to the global supply chain, and transforming people's lives by taking them out of poverty and getting them up to $1,000 a year, $2,000, $3,000, and so on. I think there's a huge public policy debate. No one wants to be associated with financial crime or anything like it. But if you look at the Transparency International's index of the most troubled countries in the world in terms of corruption, bad politics, financial crime, narcotics, all that kind of stuff, you've got an awful lot of the poorest countries in the world now. One solution, if society says thou shalt not be involved anywhere where there is a risk, you are going to get, and in fact it's happening already, a significant increase in financial exclusion again, because the risks of being involved, even with the best control of the world, will never be perfect. And I do think there's a broader point as to whether we take, you know, we take the view that no risk is acceptable, and therefore we cut out whole parts of the world, or whether we say if we could make improvements every year, it's worth it, and we've got to have a managed way of doing that. Clearly, we don't want to be involved. None of us want to be involved in things that are bad, but we do need to accept that to give people the economics that will turn them away from activities that none of us want to know about, be involved with. We need to build societies, which means having a financial system and access to the financial community. Look, I'm not a public policy maker, but I do think that's a real debate.
Let me just follow up on this debate. I know there was another person in the audience. I think we're pushing the time. I think we have 5 minutes left. Good. Related to that, I mean, you spoke about a code of ethics, and there's clearly a change. And you know, you're all chairmen and chief executives of boards. You draw up new ethics rules and hope this is now the solution. But what obviously affects behavior on an individual level is very much their own personal incentives, and we've seen, you know, if you look at the LIBOR scandal and other things, they you know, traders and those engaged in these scandals were, you know, incentivized by the bonuses they received. So to which extent do you think that the remuneration structure in banks had contributed to that? And do you accept these externally imposed limits, like by the European Parliament? We've seen in Europe now the cap on bonus that one can, I suppose, the banks have already found a way to circumvent it. But apart from this sort of initial, I would call it an initial piece of legislation, you know, there seems to me a progress that will ultimately relate to in something that is likely to be effective. But how do you see that? Is that the way to go, or is it something you can pretty much sort out yourself much better?
Well, I guess one of, clearly the quantum, I can tell you, unfortunately, that in going through the post-mortem of all these issues, you do find out what motivates people in a more granular way. I can tell you that financial incentives was definitely a point. Not to be underestimated is the status orientation, the ambitions of certain peoples to decide whatever the financial outcome for them would be. It's also a very human element, the desire to be seen as a successful person in any organization or in society. It's also a major driver. But I guess when you look at the financial incentives, I think that, of course, I'm not going to open a debate about the quantum. I think that it is the way you pay, for sure. I can tell you clearly that in our example, today compensation model, if we would have had this compensation model being introduced in 2004, 2005, most likely, I would say, very, maybe with an even higher degree of confidence, we would have not needed the Swiss Confederation to intervene in rescuing the bank. Because the clawback features that we have today in case of mistakes that are done gives us the possibility, because, for example, we have 3 to 5 years deferred planning. Clawback that are linked to the performance, not only of the year of the award, but also the forward-looking performance. So in case of a big disaster, you would claw back the vast majority of, if not all, the bonuses paid, not only in the last year, but up to 3 to 5 years. And therefore, you can see how, to some extent, the industry, through pressure, regulatory pressure, public pressure, shareholder pressure, has been reacting to that. So I have my doubt that a top-down imposed regulation will do much better than that. Maybe yes, maybe no, but it's not really the issue. The quantum is a problem, but the real problem is to make sure that people are paid for sustainable performance. And you can only measure sustainability over the next at least 3 to 5 years.
Yeah, I think I would agree. I think the proper incentivation or disincentivation, that's the real point. And as you know, we have been, there was regulatory activity in that field, be it from the FSB or otherwise, and that, in my opinion, makes a lot of sense, and it was necessary, particularly in our industry. What the EU has now proposed in terms of a ratio between fixed and variable, in that context, is absolutely useless. I think it's silly, quite frankly, and in my opinion, it was a pretty obvious populistic way to get CRD4 through the Parliament. I don't think that has any effect from that perspective. I think it's a relatively stupid, unintelligent way to regulate it, and it will have actually negative consequences.
What will be the intelligent way to do it? What would you recommend they should do?
No, I think, rules or I would say criteria as to how you incentivize people, what are the short-term, long-term instruments, introducing, as Sergio has said, clawback features that are tough, performance criteria, proper performance criteria that are risk-adjusted, and so forth.
Yes.
Everything that you would find now in a modern compensation system, as many modern companies have it, works to that effect, because it basically underlines sustainable performance over a certain period of time. There are certain other things that one can do that goes more towards the direction of the day one recognition of revenues and so forth. That's a wider element. But to regulate ratios between fixed and variable, in my opinion, is absolutely useless.
Maybe just to add on one point. For example, in the last 18 months, we introduced in our compensation, basically, it's not enough to just have a good financial performance. If you don't have, in terms of audit items being closed, or any regulatory issues, any problems with the rules of conduct or ethics, this is a huge penalty factor in the assessment on how people get paid, and promoted or not promoted. So it's very important. It's a scorecard that is as financial incentives and behavioral incentives linked. If you add on the clawback, I think that we have a way to address many of the issues, not all of them, because we will always discover new problem as we go forward. And there is, by the way, in banking, like in society, there is nothing like risk-free. We are paid to take risk. We are managing risk. And what we have to do is to make sure that when risk issues comes, like wrong behavior, we are able to detect it quickly and avoid the problem becoming bigger. We cannot run a business without risk. And we employed 62,000 people. Of course, there's going to be some people who are crazy or malintentioned. And what we have to do is to have systems to detect them quickly, not to try to pretend that we're only going to employ good people, because, we cannot, no matter how good we screen it.
We're in an industry where the outcome from actions taken in period one might extend over 5, 10 years. And therefore, I think one of the great successes over the last 5 years, partly in response to the problem, largely in response, was effectively creating a remuneration structure that deferred a large part of the reward, so that since the outcome was spread over many years, there was an opportunity to recalibrate reward if things turned out to be different than were expected. I think that's a very good thing. I think in relation to quantum, 2 points. One is, I think there's a huge governance issue here. To say to a privately owned company, one that has not been subject of receiving public, or is not in receipt of public money, to the board of directors, you're responsible for running the company and the governance of it, but you have no say over what and how you pay your people, I think would almost be intolerable, and I think would be wrong. I think if you believe in governance, then you have to say to the people who've been given that accountability, we leave it to you, but you have to report back on how you do it, which is the second point. I'm a great believer in transparency, not just for our industry. I mean, I think all industries should lay out, not with names, but with bands of how they pay their top people, indeed how they pay people in organizations. I think shareholders have a right to know what the range of reward is. But to actually find a way of quantifying it, the biggest banks in the world today are Chinese, and I don't think there's one chief executive paid more than $150,000. In America, the rewards are at the other end of the scale, so there's no way you're ever going to get to an international consensus as to what the worth of a banker is. Although I'm sure society would have a go, and it would probably be at the low end of low. But the point I make is, if we believe in governance, then surely if we have boards of directors that are appointed by shareholders, then they have a duty to determine what's right for the stakeholders they represent.
Okay, I have to finish now. Thank you very much. We had a very, very interesting discussion, and thank you to the panel. And thank you.